Tyler, you and I have talked about Dollar General over the past few years, and I'll fully mea culpa here. At one point, I was pretty confident that they would be able to right the ship based on the idea that where they're focusing, the consumers that they were focusing on, they were going to be able to leverage that, provide good prices, get good costs on their end, and turn that into earnings. And it absolutely hasn't happened. Company's made some big changes, brought the former CEO who led the company through its best growth period. He's come back to run the company again. We might have some hot takes about that. You ready to take a closer look at Dollar General and talk about whether or not we see any signs for a turnaround?
I might be the one dumping cold water on you again, but yeah, let's go through it.
Yeah, I don't think you're going to be dumping cold water on anybody this time, but there are some positives. We'll get into the positives and also the warning signs too. I'm Jason Hall. This is Investing Unscripted. That's Tyler Crow. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go check out our special link. It's fool.com/unscripted. You can get access to The Motley Fool's 10 best stocks to buy right now. Okay, Tyler, I'm going to bring up on the screen a chart here, and we're going to just take a look. This is over the past 5 years. You go even further back, and again, you can see there was a period where this was a great stock. It's a great stock until it wasn't. And it's actually very much underperformed the S&P 500 over the past 10 years because of the big sell-off that we've seen. I'm going to bring this back and just look at this 5-year period again, and we throw revenue over it. And it's like, well, you know what? Wow, it's still growing. Revenue's still going the right way. Something happened along the way, and profits have dropped back to pre-2020 levels on a per share basis. What the heck's happened?
Some of the things we discussed prior to going into this and some of the reasons that we've seen this happen is they've had a lot of problem with same store sales growth. A lot of the revenue gains that we have seen at Dollar General for much of the past decade or so have come largely from a large footprint expansion, which at the time worked, right? I think if in terms of like total store footprint, Dollar General is probably more has the largest retail footprint in the United States compared to even like somebody as large as Walmart. When you have that many like footprint growth, it certainly it looks really good and you can grow sales, you can grow earnings, everything looks great. The problem is that you start building out such a massive footprint of stores that trying to refresh them, keeping them stocked, keeping them employed, having to do the in-store refurbishments hasn't quite lived up to what they were doing. Now, for the longest time, it worked, right? Up until 2022, which unsurprisingly, the time when this really started to unwind for Dollar General was in 2022. And if we want to talk about from a macro perspective, we saw high inflation rates and rapid increase in interest rates. And basically, what ended up happening was the purchasing power of the average Dollar General customer, which tends to be on the lower scale of the income brackets, purchasing power started to go away. And then they've seen what they, in industry terms, is they've seen a sharp increase in shrinkage, which is a euphemism for stolen goods. So we've seen some combinations of some operational hiccups, some macro headwinds that are specific to Dollar General relative to a lot of other retailers over the past year and a half. And
Right.
you toss all that together, and I would argue a little bit of a management asleep at the wheel, still focusing on the go, go, go growth, build out the footprint, when it was pretty clear that the same store sale margin or same store sales metrics were in trouble. And I could go into some of the other stuff, but maybe I'll save that for a bit.
Yeah, I'm going to bring up on the screen here the second quarter results that was reported about a month ago when their most recent financial report. And just to highlight what you're talking about, 4% total sales growth, 4.2% growth. Same store sales were up 0.5%. I would really want to hammer on this, Tyler, because really what that means is that their sales went backwards on a real basis because 0.5% doesn't match the 2.8% inflation we've seen over the past year. So that's a big hit. And that's a big part of the reason we saw operating profit fall so much. They're realizing lower margins. They're seeing operating costs go up because labor costs are going up because, again, these are tough stores to work in. I know people that run these stores, and it's a hard business to be in. You're dealing with the consumers that, like you said, these are the consumers that are most on the margins in terms of disposable income. Todd Vasos, the former CEO who's come back, talked about that. While we believe softer sales trends are partially attributable to a core customer who feels financially constrained, he did go on to say, we know the importance of controlling what we can control. The reality is that we haven't seen them start actually controlling what they can control. The market certainly reacted that way, sent the stock down a ton after the company reported earnings. Looking beyond shrink, looking beyond the operational headwinds, the last thing that I want to highlight that I think is a big challenge for the business that continues to weigh on them, that is a product of that constrained consumer, is sales mix. A big part of the thesis for the business and part of their strategy was to provide that sort of a mini Walmart in a lot of markets that aren't served by a larger retailer, maybe don't have a supermarket nearby, a place that you can go and get a little bit of everything, maybe not a lot of selection, but a little bit of produce, some refrigerated and frozen goods, in addition to all of the dry goods and other things that you would look for in a general store. And the idea would be people would come in for some of those staple items and pick up more discretionary things that they get higher margins on. That hasn't happened, especially over the past 2 years. And that has extraordinarily weighed on their bottom line and resulted in the business being where it is today.
Yeah, there's part of me that says that we talk about it now as this mix thing and why it's happening now. But if you look at Dollar General's numbers over the past 10 years, this has kind of been a slow motion thing happening for a while now. And I want to focus on two things here basically. It's asset or inventory turnover and days outstanding inventory, which are measurables that you can use in the retail space of like how fast you're actually moving your product, because the more you can turn over in your store, the better off you're doing. In 2015, we had an inventory turnover about 4.9 times. So basically, every year you're turning over almost five whole stores worth of goods with days outstanding inventory of about 74 days, which all in all sounds pretty good. Fast forward 10 years today, and we have inventory turnover all the way down to 3.8 and days outstanding inventory at 94 days. You're basically like more than a quarter of a year sitting with on inventory. And with that drastic slowdown in inventory, that's inevitably going to lead to problems on same store sales and kind of those margin decreases, because when it comes to retail, you can only sell what's in your store, right? And so a slow turnover at a retail store is like a death of a retail store. You need to turn product over. And so when you see numbers like this, I don't know, it seems to me like it's been indicative of something that's been an issue going much further back than it just seems that today people are starting to notice it.
Yeah, no, I think that's right. I think we've kind of hammered on the problems as much as we can. And I will say, I do think there are clear warning signs at play here. But I do want to say, if there is one kind of glimmer of hope for investors, is now's the time to maybe think about this as a turnaround play. I do want to share on the screen here some metrics about valuation, because I do think that there is some potential opportunity, but if it's for investors that kind of live more on the risk end and are willing to ride out a substantial period of time for the economy to be stable, and also to see if management can stabilize the results. Because I think if they can stabilize the results, there could be something here. Again, from a valuation perspective, as is typical, you see it trading for about half-time sales. Usually a little bit closer to one-time sales is a little bit more normal for a large retailer that gets lower margins, so substantially discounted. Then you start looking at price to cash flows less than 6 times, 13 times earning. That's even with the earnings down as much as it is. The market's clearly very down on the business as it is right now. So my one glimmer of hope is that I do think it's a viable business. I think it's an important business. The balance sheet's not great. It's about $7 billion in debt. They added around $3 or $4 billion in debt back during the pandemic. They've increased their cash, but not a whole bunch, about $1.3 billion in cash. So the debt is certainly serviceable. There's plenty of cash to support the business. And it is cash flow positive. They generated like $1.7 billion in cash flow over the past couple of quarters. So there's money there, and there's a clear good business underneath all of the trouble. It seems to me like maybe it's priced more appropriately for investors that are willing to invest in that turnaround.